Okay, welcome to the Chapter 6, Section 6.1, Types of Business Ownership presentation lecture, which is going to fall into the content in Chapter 6 revolving around business ownership and operations. So let's go ahead and get started with Section 1 and talk about different types of business ownership. When it comes to different types of business ownership, there are three types that we are going to focus on. There's sole proprietorships, partnerships, and corporations. The difference between these three different organizations is sole proprietorships have one owner and one owner only, partnerships have more than one owner, and corporations have many owners. So that is the base in regards to these different organizations and how they differ from each other. Now, some of the operations within these different businesses are similar, but some are also different. So let's take a look at them a little bit more in depth. A sole proprietorship, business owned by one person. Believe it or not, about 3/4 of all businesses, that's 75% of the businesses in our nation, are sole proprietorships, which means one owner. Small businesses do rule the U.S. economy, no doubt about that. When it comes to a sole proprietorship, there are many advantages. First of all, they are easy to start. Proprietors keep all the profits. Proprietors are always in charge, and taxes are lower than they are for a corporation. And of course, I'm sure as you have probably thought in your head, even though there are advantages, there are also disadvantages. So when it comes to disadvantages in a sole proprietorship, one is unlimited liability, which means when the owner is responsible for all of the company's debts. If the company goes into debt, the company goes bankrupt, that owner is liable even with personal assets in order to cover those debts. So unlimited liability. Not an advantage for a sole proprietorship. Other disadvantages of a sole proprietorship are limited access to credit. You may run out of money. The business ends when the owner dies. If there's no way to transfer the business over to a new owner, once that proprietor passes on, that business will then cease to exist and will have to come to a close. The owner may not have the necessary skills in order to make the sole proprietorship successful. So many advantages and disadvantages to sole proprietorships, but remember, they do make up 3/4 of the businesses in the United States. Partnerships. Partnerships are businesses that are owned by two or more people, and they share the risks and the rewards. If you want to start a partnership, then you need to have a partnership agreement in place. Advantages to partnerships is that they're also very easy to start. They are not dependent on one sole person. It could be easier to obtain capital because now the risks and rewards are dispersed amongst more than one owner. You are only taxed once, and we'll get into the taxing issues between the different three types of business organizations here a little bit later. It's easier to obtain credit when you have more than one owner, and you also might have more than one owner with a diversity of skills. So you might have somebody who is very knowledgeable in marketing and another one who is very knowledgeable in accounting, and the two personalities and skill sets make for a successful partnership. Now, there's also disadvantages to a partnership. Business risk is shared, so even if one business owner isn't very responsible, the other business owner will also take on that risk. Unlimited legal and financial liability is shared, so you still have to kind of tie yourself in terms of personal assets and personal accounts with the business itself. If one partner makes a mistake, all partners are responsible. Team effort. Now, corporations is a big business, in which case the owners, there are many owners. Corporation, the owners must get corporate charter from the state, from where their main office will be located, so wherever their headquarters are. Corporation is a company that is registered by the state and operates apart from its owners, meaning the owners of a corporation are the individual investors. Usually corporations are publicly traded on the stock market or stock exchange. When it comes to corporations, there is limited liability, which means holds a firm's owners responsible for no more than the capital that they have invested in it. So if you are a stockholder, if you have invested, you bought, say, 10 shares at $10 a share, that is all that you're going to lose if the company were to go belly up. You would not be responsible for all of the assets and all of the losses of that particular corporation. Limited liability. Advantages of corporations are the limited liability, the ability to raise money by selling stock and publicly trade, and then also business does not end when an owner dies, because there are many owners. A new investor could come in and take the place of the owner that had passed. Thus, the business can go on with business processes as usual. Now, disadvantages to corporations is this thing about taxation. And when it comes to corporations, corporations are double taxed. Income is taxed, as well as stockholders pay taxes on the profits issued to them. So it's taxed twice. Along with the advantages of any type of business organization, including corporation, there are advantages and disadvantages. Within corporations, there's also more government regulation and can be difficult and costly to start. But once they are going, once you get them up and running, it can be a very advantageous way of running an organization. All right, when it comes to the different types of business ownership, U.S. sole proprietorship, partnerships, and corporations, here are the breakdowns. 72%, or roughly 3/4 of all businesses, are sole proprietorships. 20% reside in corporations, and 5% reside in partnerships. The 3% are others, such as nonprofits, charters, and things of those natures. And then when it comes to the amount of revenue generated by each of these different business ownership, here's what's interesting, is that the scale totally gets flipped. Even though there are 72% of all businesses that are sole proprietorship, 85% of the revenue generated by each type of business comes from corporations. Only 5% come from sole proprietorships, and 8% come from corporations, and 2% come from others. So an interesting dynamic when it comes to the types of business and the amount of revenue that is generated by those businesses. Other ways to possibly organize businesses are cooperatives, nonprofits, franchises. And we'll talk about these as well as we go through this chapter's content and move forward with different business organizations and get to know these a little bit more as well. When it comes to other ways to organize a business, a cooperative. What is a cooperative? This is an organization that is owned and operated by its members. So a cooperative could possibly be considered a credit union. Let's use a credit union as a pretty good example, because its members are also its owners. They have stake of claim in the success of the organization. The purpose of a cooperative is to save money on the purchase of certain goods and services. So you can receive different benefits to banking with a credit union versus a commercial bank, for example. That's how the cooperative is going to be able to give different benefits to its members in terms of goods and services. Nonprofit organization. This is a type of business that focuses on providing a service, not making a profit. Now, nonprofits usually do not pay taxes because they are not in business to make a profit. Because it does not make a profit is why it is not taxed. So when you're providing a service, not looking to make profit, either taking what is made in terms of business operations and kicking it back into the organization, or possibly even back to different charitable organizations in order to give them a positive outlook on the nonprofit organization itself. The benefit to that is there's no taxes to be paid on that. There are still expenses that need to be paid in terms of running a nonprofit organization, and those have to be covered in what the nonprofit organization makes in terms of income. But the one thing that is the benefit here, again, can't emphasize it enough, is it is not taxed. A franchise is a contractual agreement to use the same name and sell the products or services a company is designated a geographical area. Now, franchises could be a McDonald's franchise, used in fast food industry, Subway franchise. Those are all considered franchises, in which case you might have a local owner, but that local owner is going to operate under the umbrella of the McDonald's corporation, meaning that all of the sales, marketing tactics, ways of doing business are going to fall underneath McDonald's or that particular franchisor's processes, which will have to be followed by the franchisee. Now, to run a franchise, you have to invest money and pay franchise fees or a share of the profits. So it is not free. You get to use the business organization's name in order to get yourself established. However, because of that, you have to share your successes with that franchisor. This concludes the presentation lecture in section 6.1, types of business ownership. So if need be, please go back and revisit the slides so that you can get all the notes and submit them on Classroom once you have completed the notes for section 6.1 and section 6.2. Section 6.2 will be a separate presentation lecture, so make sure to be looking for that, as well as getting the notes down for that and submitting it in Classroom when finished. And I will see you in the next class period.